Okay, thanks everybody for joining us. This is going to be recorded, and one thing I mentioned at the beginning of all of these webinars is if you aren't familiar with options and or this particular strategy, or you're new to options wanting to learn, watch it again as soon as you get this sent to you in an email. That way, when you watch it over again, it will put this into your long-term memory. If you wait a month or so down the road, it's going to actually be like learning it all again. So please watch it again as soon as they send it to you, or as soon as you have the opportunity. Anyway, this is going to be on how to trade a bullish assumption with call spreads. Now, a lot of people might be saying, hey, this is ill-timed after today's market sell-off, but at the end of the day, I'm one of the persons that is going to tell you the contrarian type of strategy. In a sense, I love it when the market's sold off a lot in order to start taking advantage of upside potential, which I think we could easily see. We talked about this a little bit before we started airing this, that we had a lot of market turmoil today with the Fed governors speaking. And at the end of the day, I think the market is going to kind of shrug that off maybe in the meantime for just those reasons, that it's talking heads and we might see a bit of a pullback. I am overall bearish for the most part, but this gives us the opportunity when, if I'm bearish the overall market, that means I'm short deltas, and short deltas means, I have positions that are will benefit from a downside move. This would be adding long deltas. So when you get these pullbacks and things of that nature, then that's when it is actually a good time to add some long deltas into your portfolio. So I think it's actually a pretty good time for this particular webinar. Anyway, let me get a couple of things out of the way. My name's Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from geopolitical to economic and market analysis. I've been trading my own money for well over 20 years. I actually started trading in college with a psychology degree, switched it over to finance after I started trading on my own with some money I'd earned throughout high school and things like that, and decided to switch it over to finance. But I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your own portfolio, and most importantly, take control of your own risk. If you have a financial advisor out there managing your money for you, at the end of the day, that person is probably going to make the same mistakes you would if you were to do it yourself, and you're not paying all of these fees for them to just watch over your money. At the end of the day, those fees will increase your yield if you weren't to pay them. So why let somebody else manage it? Do it yourself and pay yourself in a sense. Anyway, I've traded in most markets throughout my career. Like I said, I started trading in college with some stocks and then moved to Chicago to work at the Board of Trade, and I've traded everything in that time from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. That was a crazy day, to say the least, when we're expected a interest rate increase and they did not do anything, which caused the markets to really fly all over the place one time. Anyway, this is a disclaimer I got to go over. This is any opinions, news, research, and analysis or other information contained here or material provided by ProTrader Strategies, associate companies, or employees is to be provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities that we're going to be talking about, or even the strategies. The reason why I can't give you guys like go out and blanket just say, hey, this is a great opportunity to buy a particular underlying or implement this particular strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm talking about could actually be counterintuitive to what you're doing. So what we're trying to do here is to teach you, give you these tools that you can then implement into your own portfolio in your own way. And the bottom line is do your own homework, Please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Anyway, so this is how to build a call spread. Now, it may seem like a very simple process, especially for those of you who have been trading options for some time, but I'm going to give you some of my rules and some of the things that we used to do on the floor in order to increase your probability of success with this. Because a long call spread, which is what this particular one's going to be about, is a lower probability trade. It's because you're fighting an uphill battle with theta decay. So I'm going to teach you guys some different little tricks of the trade in order to negate some of that theta decay that you're going to see with these options. Now, one thing with a long call spread is you can either pick an in-the-money call or an at-the-money call. I'll talk about both of those, and then we're going to be selling an out-of-the-money call. Now, where do we pick those strikes? One thing that I like to do, if I'm really bullish the underlying, say for instance there's been a big pullback, maybe a 10% move downward in the underlying, I might pick the one that is at the money and then pick an out-of-money call. Now, if I'm a little leery about the upside potential in this, but I'm still bullish. Now, mind you, we are still very bullish when we're implementing this strategy, or we're at least, strongly bullish, I should say, and we're pretty sure this is going to go up. Then I will pick the in-the-money strike. Now, if I'm going to pick the in-the-money strike, I default to an 84 delta. And I'm going to go into all of this, the different scenarios on how to pick these out. But I'm going to pick the 84 delta. And the reason why I would pick that 84 delta and then the out of the money call I'm selling, I'm trying to pay as little extrinsic value as I can. And by selling that call, I'm basically selling all the extrinsic value, which is that theta decay, that theta component that we're worried about. If the market doesn't do anything, that theta decay is going to eat away at our profits. And by picking the in the money 84 delta call, we can sell an out of the money call and basically finance that, because the out of the money call is all extrinsic value. So when that decays out, then it basically is paying for the theta decay we're seeing on the in the money call. So in a sense, what we're doing is with this type of scenario with the 84 delta and selling the out of money call to finance that extrinsic value, in a sense, it's like a collar. So for some of you guys that are very into options trading, by creating the long call spread with the 84 delta and financing it by financing that extrinsic value by selling that out of the money call, it's creating a collar. And a collar is basically if you were to buy a stock and then you would sell an out of the money call and then buy an out of the money put. Now, the reason why you would do that is because if you were long the stock, you'd want to be able to put that stock to somebody. So that's why you would buy that put. It reduces your risk to the downside. And you would sell that call really to finance that put that you're buying, in a sense. So it limits your upside potential, but it also limits your downside risk. That's the collar. And this is the same thing. If we're buying an in-the-money put, we have reduced our downside risk on this underlying, that if it goes below our in-the-money call, that we are no longer at risk anymore any further down than that. But by selling that out of the money call, we've also capped our upside. But I'm going to talk to you about all of the probabilities of that even happening when we go into it in detail. And then if we're picking the at the money call, that's when I'm maybe seeing a big drop in this and there's just no reason. Maybe it's some longs that have just really started covering after an earnings and they could have even beat earnings, and you see the sell-off happen a lot of times. So that would be a good opportunity to get into that after you see that big sell-off. So in a sense, when I'm implementing this strategy, I'm going to be looking for like a 10% correction in this underlying before I start implementing this strategy. Wayne, can you give some examples of what you're talking about? Absolutely, and I'll get into that in a minute. Let me just go through a couple more slides here, and we'll get into the meat of this, or the nitty-gritty, the fun stuff. But anyway, so picking the right strikes. Like I said, if we're picking the one that is in the money, we're picking an 84 strike, 84 delta, I should say. And if we're doing the at the monies, we're going to be doing the ones that are either just in the money or just out of the money, right there at the money, the ones that are closest to where the underlying is trading. And then the right duration. So since we're picking a strategy that is paying a debit, we don't want to see this theta decay happening. Okay, so this is theta decay, and that's where that extrinsic value starts decaying. So I'd like to get out here, especially if I'm picking the at the money and then the out of the money call spread. Like I said, if we're picking the one that is in the money at the 84 delta, we don't have to worry about this theta decay as much because we paid for the extrinsic value, and if we paid for the extrinsic value, that is all theta decay. So picking the right duration, I like to go outside of that, outside of this big sloping. So, you know, in the 50-ish area, 45 days and in is usually when I'm selling strategies, and I like to kind of go just outside of that when I'm buying these types of strategies or paying a debit for these types of strategies. And picking the right environment. So anytime we're doing these long call spreads or you're paying a debit for this strategy, we want our IV for this particular one to be below 30%. And the reason why is because we don't want the volatility to go down. We would actually rather see volatility go up. And we are really in a very low implied volatility environment right now. So this is another reason why this is a good strategy for this type of environment. Whenever there's a really low implied volatility, this would be a strategy to pick, because you don't want to be selling premium in an environment that we're in now, because the probabilities are that the volatility is going to rise, and that would hurt us in this scenario. All right. Or sorry, the probabilities are going to rise. So in selling the option strategies, that would hurt us in that scenario. In this strategy, it would help us. And even if the market goes down against us, if we see a massive spike in volatility, it can actually still help this strategy. We won't be hurt nearly as badly. So, and picking the right underlying. I can't emphasize this enough. We want to pick an underlying where there is a lot of option participation. You know, just because the stock is trading a lot doesn't necessarily mean that there's a lot of participation in the options. Kellogg is a good example of that, where everybody, you know, there's a lot of volume in Kellogg on any given day, but in the options, there's just not that much participation in there. So the bid ask is really wide. So a rule of thumb that I go with is if you're trading a stock that is less than 100, that stock in the option cycles needs to have a bid ask no more than 10 cents wide. So make that your rule of thumb. You want that bid ask to be inside or 10 cents or tighter, meaning that if it is $1 bid, you don't want to be trading it if it's, you know, $1 bid at $1.50, or even sometimes $2 at $3. That's just ridiculous. You know, by the time you get in and out of that, you're giving up so much edge to try and find somebody to take you out of their side that you're really could be eating all your profit potential up in trying just to get in and out. So make it a focus to go in there and look at the options chain and make sure the bid ask on a stock that is under $100 is at least 10 cents wide. You know, something like Apple, there's so much participation in the options. It's like sometimes 1 to 3 cents wide. 3 cents wide being pretty wide for Apple. And if it's, great question, Richard, if it's over $100 stock, you know, I don't like to trade anything that, you know, it gets a little wanky, because like Tesla, for instance, has a seemingly wide bid ask, you know, right, you know, of a plus 200 plus, but there's a lot of market participation in there, and you don't actually have to give up that much edge for like a Tesla when it might be 50 cents wide, or it looks like it's 50 cents wide. You could give up like 10 cents to get in, and somebody will hit you. If you better the offer by 10 cents on just one outright, then you can get hit. So don't always go, if it's over $100 stock, you know, look at the options chain, and you can pull up and see what the volume and what's going on during the day, and I'll get into that a little bit more here shortly. Wayne's asking, give an example of what your words mean on the bid ask. I will, Wayne. Just give me, I'm going to try and beat this into you guys here in a minute here when I pull up the platform. Okay, so know our exit strategy. All right, so if we're doing the one that is the 84 delta, the one that's in the money and the one that's out of the money, we don't want to, we want to basically work it where it is you're risking one to make two. So if it's $5 wide, you know, we don't want to pay more than $2.50 for that strategy with the 84 delta. Now, if it is the one that is the at the money, and you guys might need to write this stuff down, if it's the one that's at the money and out of the money, we're going to be looking to pay, you know, somewhere around, you know, 33% or 33% the width of those strikes. So if it's $1 wide, like, you would be paying 33 cents. If it's $2.50 wide strikes, then we're going to be looking to pay somewhere around 80 cents. Okay, so that's our initial setup, and I forgot to mention that earlier, sorry about that. But if we are looking at the one with the 84 in the money delta, then we're going to look to exit this when we've achieved a 33% increase in profit. So that would be like you're taking your let me pull up a calculator real quick so I can just walk you guys through this real quick. So for instance, let's just say we paid, we got a $5 wide strike here, right? So I'm going to end up paying for the in the money call with the 84 delta and selling the out of the money call. Let's look at that one, the one that's equivalent to a synthetic collar. So we're paying $2.50, let's just say $2.50. So when we achieve a 33% increase in that value, you multiply 133, okay? So that gives you the increase of 33%. So when it's trading $3.32, that's when I'm looking to exit. I'm not looking to ever try and achieve the full max profit on this strategy, because I know the probabilities of this strategy are low of achieving a max profit, and I don't want to go all the way into expiration with this. I don't like to go into expiration ever. And then on the one where we're picking the out at the money call and the out of the money call, that's when I'm going to be looking to try and achieve a profit. When the market trades up to my short call, that's what I'm getting out. And usually that's right around a 30, believe it or not, 30% increase in what the debit paid was. But if I was going to pick, say for instance, a 25, 28 call spread, and that 25 is right where the underlying is trading when I initiated this strategy. If the underlying trades up and hits that 28, I'm usually getting out right then. just because I know I'm beating the probabilities, okay? And usually it is right around that 33% increase. What is the ideal duration of holding on to this strategy? Well, ideal would be 1 or 2 days, Craig. But, you know, at the end of the day, it usually will take, you know, around 15 to 20 days. You know, I actually was trying to cover a put spread a long put spread that I talked about in the daily market commentaries, and that long put spread took about 20 days for, I was actually long a GLD put spread. I think it was the 29.26 put spread, and it was trading just above 26 today, and I had a bid in to cover it for, you know, 33% increase in what I paid for it. Didn't happen. I didn't get hit. So anyway, all right, so, and I will go over this a few other times once we get into the thing. So let me try and get through these real quick. So your max profit is going to be that short call minus your long call, and then subtract that premium you paid for it. That's going to be your max profit on this. So in a situation where, let's just say it's $10 wide, we paid $5 for it. It's $10 wide, so that that's the width of the short call minus the long call. It's $10, and we paid $5. Our max profit would be $5. But remember, we're only going to try and achieve 33% of that. So if we paid $5 for it, we're going to multiply it 133, and then at $6.65, that's when I'm going to look to exit. Okay. And your max loss is the premium you paid. Anytime you do a strategy for a debit, then it is going to be that premium you paid for it. Okay, the break even is going to be that long call strike plus the premium you paid. So that's going to be where our break even is. So the beauty in doing the strategy that is a synthetic collar, our break even is usually at or below where the current underlying is trading. If you're picking the one that's the at the money call and the out of the money call where you're short, then you have to add that premium in to that long call, and it usually increases, or it's going to increase where your break even is by, you know, quite a bit. So that's the trade-off there. You're paying less for the one that is at the money versus the synthetic collar, but you also have a higher break even to achieve. All right, so this is like the setup that we were talking about and shows pretty much everything. So this is GDX. This is the gold miners, and if I set this up with the 84 delta, the underlying was trading at $27.35 at the time this was initiated, or that I set this up. So the 24 strike was the 84 delta call that was in the money, and then I sold the 31 strike to pay for the extrinsic value of that 24 call that I was getting long. So you can see the break even on this was $27.30 when the underlying was trading $27.35. So my break even was below where the underlying was trading at the initiation of this strategy. And as you can see here, it is $7 wide, and I was paying less than the risking one to make two. So it would be $3.50, right? If I'm risking one to make one, or to make the two, the $6 and $7, I mean. And then onto the other one where I picked the one that was, and this GDX actually sold off by the time I did that. So please, I accidentally moved that there. But GDX was trading at $27 when I finally put this one on. And actually it was maybe even trading just slightly below it. But so I picked the at the money and then sold the 29s and paid less than a third the width of the strike. So that was meeting those rules. And as you can see though, the break even was at $27.68, so 68 cents higher than where the underlying was trading to achieve that break even. So that's the payoff. You're paying less with this one, so you need to be more bullish. That's what I was talking about. You know, if you're picking the at the money call and selling the then out of the money call to help finance some of that, you need to be a little bit more bullish. If you're picking the one that is the 84 delta, then you know that one can kind of trickle up a little bit slower and still achieve it. The ideal duration on this is going to be you know, somewhere just outside of 45 days. Craig. Yeah, so if you're paying 10% of it, it does. But you got to remember, Craig's saying, you know, he's paying 10% with his platform, and that doesn't leave a whole lot of meat on the bone for him. But keep in mind, we're looking at making, when I'm trading options, I'm looking at making singles, doubles, and sometimes triples. I'm never swinging for the home run. I want to be consistent, and I want to consistently make money. So this is the, you know, if you're beating, this is a way to beat the probability. So I don't know how many times I've seen it where the market goes up and tests my probabilities. I beat the probabilities, only see the probabilities actually come into line, and that's where you're going to lose money. So this is all about trying to beat the probabilities. So let's get into this and start looking at some examples. So great question was, I'm not going to have options on Dow Jones. So let's just, I mentioned Apple earlier, so let's just look at Apple for an example. It's going to have, I don't know why that didn't work out. For an example, so it's a $100 stock, right? And this is fun. I'm staying mechanical with this, rolling this out in time and lowering my basis on that. So if you watch the daily market commentaries, you can refer to that. But anyway, so what we're talking about for this particular strategy is if we look at Apple, it's a $100 stock, and the bid ask is 5 cents wide. So that would meet the rules of being inside of 10 cents wide, right? We want to have a lot of participation. And if you pick something like what I mentioned earlier with Kellogg, is you can see Kellogg has a volume of, you know, 1.5 million contracts traded on the stock, but the participation in here is horrible. It's 70 cents wide. So if you were to really want to trade Kellogg, I would not trade these options because they're just so wide. You're going to, and out here they're even worse. So well, it's going to be tighter than that. I mean, you could definitely offer lower than $1.85, but you can just see that there's just not a whole lot of participation in here. So this is one that is close to that $100 stock, but doesn't meet that. And if we look at the volume and open interest, you can see there's almost no volume and almost no open interest. Okay, so I would almost never trade. It's over here in my watch list, but the only reason why it is for earnings, because that's the only time it seems like people come in there to play. So this is usually when I start talking to you guys and throwing it out there for you guys to give us some examples of stocks that you like, and we'll run through the rules that I usually follow and see if it fits within that whole thing. It'll kind of help you guys understand a little bit better, so that, and sometimes maybe I've missed a nuance, and we'll go over it a little bit more. So this would not fit this strategy or any option strategy for that matter for me. So let's go back to Apple and see if we can get a better example of a good option strategy. So we're going to be looking at the 84 delta. This is what I was talking about with the 84 delta. We're going to look in here, the in the money ones. This is the one that's going to simulate a collar. And when I'm talking about like buying, if you bought the stock at $107, let's say, then a collar you would be selling it out of the money call and then buying an out of the money put. And you would try and offset those by the commissions. The ones that I'm selling should pay for the ones that I'm buying in the collar situation. That would limit our risk to the downside and cap our profit potential to the upside. This is the same scenario synthetically, but we have less margin requirements for this strategy and a higher return on capital. Okay. How many strikes wide should you put the spread on? Well, great question. So how wide should we put the strikes on? What we're going to do is I'm going to give you an options hack real quick, floor trader hack. But what we're going to do is we would look to buy this one, right? So we're going to look to buy this call because it's the 84 delta, all right? And then we got to pay for the extrinsic value. And if you've watched some of my other videos, you know I have a shortcut for that. This is going to expire in 56 days. So I've gotten outside of that 45 days. So if you look at the corresponding puts, that's going to give you a very close proximity of what the extrinsic value is. So if I'm buying these 97.5 calls, I got to pay I got to finance 62 cents. So in that regard, I would look to these because that will finance that, right? So that's how I pick those. And usually it is around a 17 delta. So that's the ones that I'm going to be looking to sell for this particular one. So we can look, we're paying, you know, you're paying a lot for something like Apple. So we wouldn't want, that might not fit for everybody's. And one thing to keep in mind when you're implementing strategies in your portfolio, you never want to allocate any more than 10% of your portfolio value to any one particular underlying. So make sure that this would be appropriate for you in that regard. You wouldn't want this to be like 50% of your portfolio value or 25% even. You want it to be less than 10%, and I would even say closer to 5 would be better. So keep that in mind when you're implementing these strategies. And that goes without saying on anybody's risk parameters as well. You never want to put all your eggs in one basket. All right, so we have a strategy that is, what is that, 15, so it's 17.5 ticks wide, right? So our width of our strikes are 17.5 wide. So the thing to do is to figure out what that is in relation to. So we take the 948, divide that by the, what did I say, 1750, and that's 54% the width of the strikes. So it's a little over the top. You know, we would like it to be less than 50% the width of those strikes on this in a perfect scenario. So I might look at that, but there might be other examples out there that work out a little bit better. All right, so everybody's throwing some stuff out there, so let's look at Nike. And one thing I did say was I like to look for something that has had a 10% drop. And if we look at Apple, I don't think Apple has had a 10% drop. One thing you can do is pull up this trend line and look at what the correction was. Oops, sorry about that. So the trend line Okay, I do have a trend line on there. So the trend line, you basically draw a line, click it if it's going to work for me, and then you can draw like that and kind of get, that's been a 4% correction. So I'd like to see a little bit more of a correction. You know, I would like to see a 10% correction before I'm really getting excited about something like this. Unless it's like Google, and Apple always seems to go up too, but Google, Amazon, they don't ever seem to have much of a pullback. So let's look at Nike. I think Nike's been doing pretty good. So they've had a big push and hasn't had it, but we can look at it if you're really bullish. Nike, you know, that was just a rule of thumb on the 10% correction, but that's the ones where I really like to get into it. And this isn't going to have an 84 delta, so I'd generally opt for paying less, so a smaller delta, if you will, and look to buy that one. And what's our extrinsic value? It's about 80 some cents. We're not going to be able to finance all of the extrinsic value on this. And we have a 7.5 wide, so we need to pay somewhere, what is that, 7.5 would be 350 and 375-ish. Math is correct off the top of my head. So it's a little bit over also. And if we look at the confirm and send, we can see that our break even is below where the underlying is trading. See, our break even is 58.95, so it looks like we were able to pay for our extrinsic value by doing that. And it's below where we are. Anytime the break even is below where the underlying is trading, it means that you pretty much paid for your extrinsic value in that option. Remember, extrinsic value is the decay that we'll see. So that's a little bit over. So the other thing we could do is look at the ones that are in the money. One thing that I wanted to mention about the probabilities, so the delta is the probability of, it's, you know, it's a ballpark of the option contract being in the money. So this 13, or let's just go with the 26 delta. So the 26 delta in that example that we have here, the probability of Nike going up and trading $62.50 and this being in the money at expiration, probability of that happening is 26%. Okay, now in the next 50 days. So at expiration, for Nike to be $62.51 at expiration is a 26% probability, okay? But the probability of Nike going up and hitting this, you know, if only for a second, the $62.50, probability of it just going up there during the life of the next 56 days is double the delta. So it's 52% probability. I got better than a 50%, 50-50 chance of it coming up and testing that. That's why I was talking about it is so important when you go up there and you beat those probabilities, that's beating the probability. If it goes up and trades 62.50, boom, I've beaten the probabilities. That's why I'm looking to close that strategy. You know, it's not about always how much meat on the bone you've left or whatever, and Nike could continue to scream higher. At that point, I've washed my hands of it and I've forgotten about it. Sure, if it spikes up to 70 overnight for some crazy reason, you know, Nike all of a sudden cures cancer or whatever, who knows, then then I might let it run a little bit longer. But for the most part, if it's just rallying up and it hits my strike, that's when I'm looking to get out. Just like I talked about with GLD going down and testing 126 today. I've beaten the probabilities in that scenario for the duration of that contract. I'm looking to get out. Okay, so and you might be taking a little bit less, but you know, over time, if you're beating probabilities, you're going to have a much better chance of success. And what's the significant? Great question, John's asking. What's the significance of the 84 delta? It makes it. It has a tendency to make that risk one, you know, scenario. So it usually makes it where I can get further away and pay for that extrinsic value. That's the significance of it. You know, I'm paying a lot less by doing it, and I can get further away. I can make my bid ask wider and increase, you know, my profit potential. It's kind of that trade-off, and that's kind of where I found that whole likelihood of being able to achieve that. Plus, you're also increasing your probability. If I've kept this in this 84, I've got an 84% probability of that strike being in the money. So, you know, I'm only risking the intrinsic value at that point. Okay, the further out you go, in here you're paying a lot more, and you can get further away, but I found that that 84 delta, and you know, that's one standard deviation away on the other side, because one standard deviation is about a 16% probability, and that's also that significance. So you're having a tendency to go 84 delta and being able to sell the 16 delta on the out of the money, and that means it's one standard deviation away. And a one standard deviation move only happens 16% of the time, but when I've beaten the probabilities of just getting touched, that's double that probability, or double that delta. You know, you've beaten those probabilities, you guys. You got to, that's what you want to take hold of. It's not about like hitting home runs. It's about beating the probabilities and managing your risk. And that's how you manage your risk. All right. So that one, I don't know if I would go with. There's maybe other examples that are a little bit better. Oh, Sophie. Sophie came up with one of my examples that I've already vetted. So Sophie, I'm going to come back to you. And Goldman Sachs. I'm bearish Goldman Sachs, but you know, I could be off. I'm bearish Goldman Sachs because I don't think the Fed's going to raise rates, and if the Fed doesn't raise rates, then that's going to hurt Goldman. And they've traded quite sideways. So I, you know, generally, like I said, I like to see a 10% correction to really go into this and risk my money on it. So it doesn't have an 84 delta, but Goldman Sachs does have close enough to it. So if we were going to buy this one, we're going to look straight across at our 150 calls, or from our calls to the puts, to see what we need to finance. We need to finance about $1.51. That's the extrinsic value. So we would look to sell the 175s. Right? So in this regard, we would be paying a lot of money for this strategy, but a lot less than if you went out and bought Goldman Sachs at $165 and created a collar. So we can look at it. Where's our break even? We add the debit we paid to the long call. That puts us at 165.51. Where is it trading? 165.97. So we paid for that extrinsic value by doing this. So really all we're doing is paying intrinsic value. So it's really like buying that underlying, right? We're legitimately buying this underlying below market in a sense. And, you know, we get to participate at 80 some odd cents, and if it keeps going up, that delta increases. The delta also adds into the premium, right? For every dollar move up in the underlying, our strike increases by that premium. Okay, so if this goes up from 165, or let's just say 166 to 167, then this, what do we do? The 150 calls will increase by 86 cents. Right? So we're participating a lot on the upside. You know, 86% of that move we get to participate in, and we're using, you know, probably a third less capital in a sense. Yeah, because the result for buying power for the stock would be $38,000, and our buying power is, I mean, it's a lot. I don't even know what the percentage is off the top. And our buying power reduction is, you know, $1,550. So you, with this, you're, you know, limiting your risk the same way as you would with a collar, but with that much less reduction in buying power. All right, so but our max profit is a lot less, so we're risking a lot more than what our potential profit is on that. So probably would not, I don't even have to do the math on it to know that $25 move, I would need it to be, you know, $12.50, right? So we're paying $3 over that limit. All right, so I'm going to go into Sophie's. Sorry I didn't get everybody's examples, but let's do a couple I vetted. Sophie mentioned Win, and if we go into Win and look at the chart, we can see that they've had a pretty big move. So we can pull this down and look at it. You can see it's 14.58% move to the downside. So that's a pretty significant move, and I bet if I pull up like a Fibonacci, it would be real close to a Fibonacci level just with that kind of move. So I'm just going to try and do this real quick. It's not going to be exact, but it's close. It's gone through that Fibonacci level. But there is, if I just do this to make a line, you can see that there is a lot of support right around in this area. Just with all of those, I'm just going to click on it. You can see, oops, come on, I want to get rid of that. You can see right here, there's been a lot of support in this area. So that would be a good place to put on something like this. Where would you put your stop loss? You know, Craig, that's a great question. I usually, when I'm doing a strategy that is the one with the 84 delta, I would cut my losses at 50%. So if I lost 50% of what I paid for it, then that's when I'd look to cut this loss. If I'm doing the one that's the at the money and the out of the money, I'm usually going to just let that one ride. Okay. Does that answer everybody's question? That's a great question, and I meant to mention that earlier on, and I forgot. But yeah, so if I'm picking the one that's the 84 delta and the out of the money, if I'm losing about 50% of what I initially paid for it, I'm out. I'm pulling the rip cord on it. And if I'm doing the at the money long call, then I'm usually letting that ride. Okay, so Win. So we could look at Win, and let's look at the one for an example of the out of the money, since we did all the ones that were the in the monies. We have had a 10% correction, so I'm much more bullish on this one. So we're looking to buy that. The Win has got wider markets all of a sudden. It's probably because it's a Friday. Usually Win has a lot tighter markets. I know I looked at this earlier today, and I looked at this earlier today and I vetted it, and it was much better, but it's less than the width of the strikes. But I'm going to skip it just because I thought Win usually has tighter markets than that. Let's go to another one then. Sorry, Sophie. I'm going to skip it just because it's not following my rules. Let's look at Johnson & Johnson. I think Johnson & Johnson had a pretty good market move. So if we look at this again, but I have it on trend line, we can look at the top here, draw a trend line, and it's pretty, let me do this. I'm going to go opposite just to get the trend going. It's only 6.5%. So I'd skip that one. All right. One more. Anybody know what an EpiPen is? Heard all the controversy? These are the guys that make those EpiPens. What? sorry, Mylan. So they've, on this epi controversy of their spike in the prices on those, they've dropped over 14%. Now it looks like some of the political people have gotten to them and they're looking to cave in. So that's got a nice move on it. They usually have inside of 10 cents, so that's pretty good. 8 million volume there. You can see probably there's probably a lot of interest in here because of everybody participating. You can see there's a lot of open interest, a lot of volume that creates a lot of players. So let's look at this one, and I think we can do just about anything in here. We could look at the 84 delta. It's 83, so that's close enough, right? So buy this one. It's the extrinsic value we got to finance. This is the, you know, you always want to finance a little bit more, so that lowers your break even. And so we add this in to this one to find out what our break even is, or you can just hit confirm and see what the break even is. So our break even on the stock is $42.98. That's below where it's currently trading, so that's good. The width of the strikes is $10 wide. Paying a little bit over that, so don't love that one. So let's look at another. So I'll look at buying this one, and then I want to pay, so 45. Let's look at $10 wide to the 50. So that's paying less than a third the width of those strikes, because it's $10 wide. We're paying $1.50, so that's like almost closer to less than a quarter. So we can drop this down, increase our probabilities of success. Let's go to the 50, see what that is. $1.19 on a $5 wide, so we're still in there. So that would probably be the one I would look at doing. Our break even is going to be when it's trading $46 though. You've got to keep that in mind. Okay, so we got to get a pretty good move up to $46 on that. But I'm pretty bullish on it. I think it could easily go back up there again. I think they even beat earnings and everything. Yeah, they even beat earnings. So that would be something that I would look at doing on that one. It's all extrinsic value, so you got to keep that in mind. So 50%, Sophie's saying, so 50% stop, 33% gain means 2 win for 1 loss to break even about. Yes, that's about right. But, you know, if you're beating the probabilities on this by getting out and staying mechanical, then that's overall, over time, you're going to be a winning scenario. Okay, could you, and just keep in mind, this isn't one that I would implement every day. It's got to, everything's got to kind of work out correctly in order to do that. A slightly out of the money call spread. Nick, I think that could you do an example of one that's slightly out of the money? That one was one that was slightly out of the money, because it's 45, right, and it's trading 23. This is closer to the at the money, really, even though it's in the money. It's really would be considered an at the money. And we could even look at the one that's in a little bit more. So I don't like doing the half strikes, but we'll look at it. So $5 wide. $5 wides, you know, we're paying less than the $2.50. So that one would be one that I would like also. We got to go $2 higher. We got to go to $2 and we got to get to $44.50 basically in order to break even on that though. But if we look at that for the 42.5 and the 47.5, if we look at the chart, 42.5 and 44.5 is below where the market's going to want to migrate to. This is where it really wants to go. And then the 47.5 is just slightly higher than that. So that would probably be the one I would really look to do, is to do this one, the 2.5s, and selling 47.5s just because it fits on my chart and everything else. and I'm a little bit bullish. So that would be one of the ones that I think is one of the best scenarios that we found all day. Does that make sense for everybody? You sometimes like legging into option spreads via opening with no, Craig, I never, on the floor, that was something I did all day long. On these kind of markets, the reason why you don't want to leg into spreads is 50% of the time you're going to leg it better, 50% of the time you're going to leg it worse. That 50% of the time you leg it worse, it's going to eat up all of your, because you're only going to be able to leg it better by maybe a nickel or so because you're going to be anxious to get in. When you leg it worse, you have a tendency to wait too long, wait for it to come back, and it's really going to hurt. Also, the counterparty on options, you know, they don't want to have, they know the risk of legging into a spread. So they're not going to give up as much of an edge to you if they have to incur more risk, right? So if they have to incur more risk, it's going to cost you more to, in a sense. Does that make sense? Counterparty doesn't want risk. These guys out there, they want to know where it's at, and they're willing to give up a couple of pennies because they know if they only give up 1 penny or something like that, or 2 pennies. Now, if they have to leg in and out, it could be costing them 10, 20 cents. So they're going to give a little bit so that they don't have to lose money on the risk. So it's called counterparty risk. I would not do it. But in something like this, I wouldn't always go to the mid price, especially in, you know, like an Apple or something like that. I'm going to go to where the natural is and maybe give up a couple, 2 pennies, and then put it in there, wait 5-10 seconds, you know, cancel replace. If you guys don't have like several cancel replaces upon entering every single trade, you're giving up money. You're leaving money on the table. And a penny or two here or there throughout the course of your career or your lifespan of this portfolio is going to be significant. So cancel, take that extra couple of seconds, cancel replace, cancel replace, cancel replace until you get to the mid market, and then that's usually where I let it sit. Maybe go a penny below it, but for the most part, that's about it. So your target debt should be less than 50% the width of the strikes. Yes. You know, perfect scenario would be a third, but this, I'm not able to find that as well. Should be a little bit better than that, really. What happens if I go up to the 50? So that's even better, right? Let's increase our break even a little bit, but that's $7.50 wide, so that's right around that third the width. I think that's actually the example I had when I was looking at this. So if we look at it, $2.37 divided by $7.50, it's right there. I think that's actually the example I was looking at. So we want, if you're doing the at the money, or, you know, I would consider this one really at the money because it's only a little bit in the money. This is really out of the money. So that's really kind of close to at the money, and we do that 50, then that's right around that third the width. The 50% one is when we are doing the 84 strike. The one that's at the money, we want, you know, because the one that's in the money, the 84 delta, has a higher probability of success. So I'm expecting I'm going to have to pay a little bit more for a higher probability of success. The one that is right here, this one has a lower probability of success. Because remember, to get up to that 50 strike, you know, our chances are only 13% of it getting up there in the next 56 days. Our chances of it going up and touching that are 26%. So that's, you know, double that. But it's a lower probability of success, so I'm going to only be willing to pay you know, a third the width of those strikes. Sorry for that. Break even, yes, the break even on this, the break even on the one that is at the money is always going to be higher than where you are. That's the beauty in the one that is in the money. By doing the one that's in the money, your break even is usually below where it's trading. So you've already achieved that. That's also part of that higher probability of success. You got to pay for more for that success. So the break even on the one that is at the money is always going to be higher, because remember, you're basically you have all the extrinsic value in those options, and you can't really finance it when you're doing the ones that are at the money. So your break even is higher on the one that is at the money. So that's why you know, I also mentioned, you know, the one when you're doing the collar scenario, the collar synthetic with the 84 delta, that one, your break even is below where the underlying is trading, so you're successful. So that's why I was saying, you know, this is one where, you know, I'm not really sure. I'm pretty sure it's going to go up. I have a bullish assumption in it, but, you know, I may be a little bit more tentative, and, you know, it may even be a slow grind or looking like a slow grinder going up, you know, like some of the staples, like, you know, Johnson & Johnson, stuff like that, where they just slowly kind of always go higher, where this is something where I'm looking for it to have a bit of a snapback, like in this one where there was just a lot of bad press. I think it's going to blow over, and I'm much more bullish in this one. So I'm willing to have my break even higher and pay a little bit less. So there's a lot of those trade-offs. Does that make sense for everybody? Anybody else have any other questions? Great. You guys, this is for all of you guys that have, you know, enjoyed this and taken a lot out of it, especially those guys of you that are some of my regulars. You guys really need to take advantage of this course. We're not going to be offering this much more. I think this may even be the last time for participants in the webinars are going to be able to get this Volatility Crush course. So you really need to sign up for it now. If you've been holding off, this is the time to do it. So take advantage of that 50% off. It will pay for itself, you guys, just like all of these strategies for the most part. But this course is one of the most important things from a floor trader's point of view to take advantage of, because it is top of mind for every trader that's been out there. From, you know, any seasoned veteran, this is the top of the mind thing. As a matter of fact, on the floor, we used to talk about it, have meetings before the open for probably a half an hour, 45 minutes, and then up to an hour or so afterwards, just talking about Volatility Crush, how it was affecting, or volatility and how it was affecting prices, what we expected volatility to do going forward, because that determined what our strategy going forward was. So this is your chance to trade like a pro floor trader, basically. And you have to understand what volatility is going to do. I talk about how to take advantage of it, learn when you're going to be selling volatility, when you're going to be buying volatility, and how to calculate what that volatility crush is going to do to your premium, so you can see exactly what and expect volatility going up or down will do to that premium. I talk about how the floor trader hacks on how to figure all of that out too, so you can figure it out real quick, kind of like that extrinsic value. You know, most people don't talk about that, but those were little hacks that we learned on the floor, how to figure out what the extrinsic value of the in the money options are. It's by, you know, looking at the corresponding strike. So those are little hacks that I talk about in these classes. So it's extremely important for you guys to learn this stuff. I also go into things that I learned as a trader while on the floor outside of just this volatility in this course. I talk about the correlation between historical volatility and what implied volatility percent is. Like we were talking about with this strategy, we want an implied volatility percent that is below 30. And I talk about when the right time is to be selling volatility in that. We're also going to be having a bonus live volatility crush class coming up pretty soon. You'll get notification of that and be able to participate in that webinar as well. The other thing is this will ultimately create consistent trading results. In all of my lessons, that is the utmost importance. Just like I talked about earlier, you know, we're not looking to get the big home runs. We're looking to get on base and consistently increase our batting average by beating those probabilities. And this course will pay for itself. That is one of the guarantees I can pretty much give you. And if you purchase this course, you also get the daily market commentaries, you guys. So I go through all of my trades, you know, when they are working, when they're not working, and when they're not working, what I'm doing to defend them, how I'm staying mechanical. So all of those lessons are added into this. So every single day, I try and make there be some kind of thought-provoking lesson, you know, or something that you can take away and use in your daily regimen. Also, if you have this course, you get unlimited access to me, or if you purchase any of my courses, you get unlimited access to me. So if a strategy is going against you, or you're wondering about a particular strategy, whether it fits the rules, you can reach out to me and I will tell you what my rules are around there and what I would do. Like I said, I can't really tell you what you would do, but I can tell you what I would do, and then it's kind of up to you to play around with that and implement it yourself. But you do get unlimited access to me, and if an email isn't enough, you can reach out. I'll reach out to you for a phone call. I'll just be like, hey, this is way too in-depth to really put in an email. Let's chat, and I would be happy to do that for you to make sure that you're successful. So all of those things combined. Also, you'll be able to talk to somebody pretty shortly after this webinar, and they're going to give you all the answers you can about this particular one. If they can't answer those questions, they'll put you on to me for that. All right, so take advantage of this. I can't stress it enough. Volatility and volatility crush is something you have to know by the back of your hand in order to be successful. So if you haven't taken advantage of it yet, this is basically your last chance to get it at 50% off. So I highly suggest you learn this by heart. So you need to take advantage of it. All right? Reach out to Pro Trader Strategies. Later webinars, and also you guys, how many modules are there's a lot more than even are just listed here. There's several other ones, and somebody, when Robert calls somebody at a Pro Trader Strategies, and anybody has any questions about that particular one, we'll give you the whole list of all of those. I think there's 15 or something. I can't remember off the top of my head how many there are, but there's a lot. You can reach out to us at 310-598-6677, or you can email us at trading@protraderstrategies.com. And like I said, they will get you directly over to me if you have any questions that they can't answer, and or you know, if you've signed up for the course, they'll get you over to me if you have any questions about your trading and what's going on with that. Later webinars, we're going to be drilling down on options components, how to trade them, where I find them, when I find them appropriate. This, sorry, is not the right link for that particular one, but if you go to the link that is in the chat box, you can easily click on that to get you directly to that particular options volatility crush course. So click on that window that's in the chat box, not the questions box that we've been currently using here. All right. Are you, Dot's asking, are you already in MYL? No, but I am going to be most likely 90% going to be implementing that strategy on Monday. So I'll be talking about that in the daily market commentaries. So if you haven't watched those, you know, they're only like 10 minutes long. I talk about data points and everything else, and what the economic outlook I see from the data, and all kinds of things. The trades I put on when I take them off, if I'm doing an earnings trade, how I'm going to do all that. And I give you the prices I paid and the prices I'm getting out, and whether it's a win or a loss, I'm very transparent in that. So watch those, and I'll tell you exactly what strikes I pick. As long as it's not up like $10 on Monday, I'll probably be doing that one. All right? And reach out to us also. If you have a webinar you want me to do that you haven't seen me cover, then please reach out to us, because I'd like to increase the content and make it appropriate for you guys. All right? Have a great weekend, everybody. Thanks for sticking around a little bit longer. If you can't take that, take it easy.